This video has examples for Chapter 10 for Principles of Accounting 1. In Chapter 10, we are looking at long-term debt or long-term liabilities. In this first example, we are looking at debt versus equity. So looking at different financing and what that does. So we have a company that currently has $230,000 worth of equity. So that's our common stock and retained earnings. And we're planning a $92,000 expansion to meet increasing demand for our product. We currently earn $57,500 in net income, and the expansion will add on to our income before any interest expense. So we have three different options. One, not to expand at all. Two, to expand and issue $92,000 in debt, so take out a loan that requires payments of 8% annual interest. Or three, expand and raise $92,000 from equity or by selling more stock. So the benefit of selling stock is you don't have to pay interest on it. The downside of that is you increase the amount of people who have ownership rights in your company. So in our first example, we have option 1, don't expand at all. So in that option, we have $57,500 in income, because that's what it told us. We have currently, we're not going to have any interest expense. So let's look at this here. Our net income is income minus interest. Our equity is $230,000. So the return on equity, which is equity divided by net income, net income divided by equity, or how much income do we generate from our current amount on equity. It's a measurement of really how successful we are. We have multiple different return on assets, return on equity, and return on investment are the three main ones. So then in option 2, we expand and we issue debt. So if we expand, we have $57,500 plus $28,750 in additional income, because we're going to get that. Okay. We're also going to have interest expense. So we're taking out $92,000 in loans. So we're going to take $92,000 times 8%. So we're going to have this annual interest expense. Copy this over here. So we're going to have net income. Our equity remains unchanged. And so at this, we have our return on equity is 34%, and we can even extend that out 1 or 2. The main thing with parentheses, if you extend it out 1, you want to extend them all out 1. And in option 3, we have the increased income. We don't have any interest expense because we raised the amount of equity, but now our equity is $230,000 plus the $92,000 that we sold to borrow to get this. Okay, so if we were trying to make the decision based on what gave us the best return on equity, then option 2 is the best option. If we said we want to have the best net income option, then option 3 is the best option. You will talk more about debt versus equity options in business finance. In this next example, we're going to look at bonds. So if you read the chapter and then you watch the lecture videos and see these examples compared to the chapter, you will notice that there's a lot in chapter 10 that we decide to skip. And that is a decision we made a couple of years ago to skip premium and discount bonds in Principles of Accounting 1 and to just focus on bonds in general. And then in business finance, you spend much more time on premium and discount bonds. So making sure that we have this solid foundation of just bonds in general before complicating that information with premium and discount. So we don't cover that in Principles of Accounting 1, so we're skipping those parts of the chapter. So we have this example. We have issued bonds at dated January 1st, 2023, have a par value of 5.1 million, and they mature in 8 years. And we're going to pay 8% interest semi-annually. So first, we're going to record the entry for the issuance of bonds on January 1st. So we're going to have cash and bonds payable. So we sell bonds. I'm going to make those a little bit bigger. We're going to need to make these bigger for $5 million also. So we received cash of $5,100,000. And now we have a bonds payable of $5,100,000. On June 30th, we're going to pay interest expense. I'm going to throw in. So this is on January 1st, and now it's June 30th, and we're going to pay interest expense on our bonds. On interest expense. Just a little bit bigger. Oh, that's because I put that. That's why it's doing that. My Control Z doesn't work to remove it. My Z sticks on this keyboard. And we're going to pay cash. So we want to know, what is that 8% interest expense? So we have $5 million in bonds times 8% interest times half a year, or 6 divided by 12, or times half, or whatever way you want to do it. So that interest expense every 6 months is $204,000. The next interest payment is on December 31st. So same journal entry, we're going to have bond interest expense of $204,000 and pay cash of $204,000. Then at the end of 8 years, we are going to pay those bonds. So bonds payable of $5,100,000 and cash of $5,100,000. We don't have interest expense there because we've been paying the semi-annual interest throughout the years. In this next example, we're looking at callable bonds. So when callable bonds means that bondholders can call those bonds in early, or they can happen late. And so what happens is we have this bonds with a par value of $10,000. So we have bonds payable of $10,000. And when we have this call option, we have to pay a call premium of $500 plus par, or a total of $10,500 to bondholders to retire the bonds. On July 1st, we exercise the call option. Okay. One of the reasons that we might call in bonds early is because we have the cash and we don't want to pay interest anymore. So that's one of the reasons why we have that call premium. So we have to pay them something for calling them in early. So we've got the cash available and we're going to call them in early. So we're going to have our bonds payable, our journal entry. We had bonds payable of $10,000 that we're removing from our books. Then we're going to have a loss on retirement of bonds. We're going to have a discount of bonds payable. And we're going to pay cash out. So I'm actually going to move the debits here. So $10,000. And we have to pay now, we have this discount on bonds payable. So they're carrying at $9,000. So we currently have a $1,000 discount. And so we're going to pay $9,000 cash because that's what the current value is. We have to pay $10,500 in cash to retire the bonds. Okay, so now our debits have to equal our credits. Okay, so the loss on that bond retirement is because their carrying value is $9,000 and we had to pay $10,500. We have a loss on retirement of $1,500. Okay, in this example, they're on a premium. So I'm actually going to copy this. And we still have a $10,000 bond payable and we still have to pay $10,500 in cash. But now we have a premium on bonds payable. Because they're selling at a premium for more than their value, and we have a gain on retirement. Okay, so we have a $1,000 premium, and because our debits have to equal our credits, our gain is $500. Next, we're going to look at an installment note. So we have this installment note. We borrowed $165,000 cash by signing a 4-year 8% installment note. The note requires 4 equal payments of $48,000. I should have changed that. $817. What I have over here, I use the payment function to calculate what the yearly payment was over 4 years. Okay, so what we're doing is we're building an amortization table here. So what an amortization table looks at is when you pay a full, a regular payment, what part of it was interest expense and what part was your premium. So we have the beginning balance of this loan was $165,000. We have an 8% interest. So the balance times 0.8. Okay, so our interest expense is $132,000. So the amount that we paid on the principal is the balance minus the payment minus the interest expense. So payment minus interest expense is what we paid on the balance. So now our ending balance is $165,000 minus the note payable. That becomes our beginning balance. We then have 8% interest. So our interest payment here. And then we have our payment minus interest expense. And now our remaining balance at the end of year 2 becomes our beginning balance for year 3. We have 8% interest. And then, so the nice thing with an installment loan is that you pay more and more against the principal and less in interest every year that the loan exists. Installment loans are similar to mortgages, car payments. These are the types of things that are treated as installment loans, where you have one payment that combines interest and okay, so when we come out on this, we should be at 0. Okay, or we're off 30 cents here because of rounding. But at the end of the payment, we should have a 0 amount. Okay. In this example, we're going to look at the debt to equity ratio, which is how much do we have is our debt to equity. Okay. And so how we calculate that is we take total liabilities divided by total equity. So for Atlas Company, we would take total liabilities divided by total equity. And we have a 80% debt to equity ratio, or 0.8. Actually, I want that to be 0.8. And for Byron Company, we're going to take debt divided by equity, and we get 3.16. The company that has the riskier financing structure is the Byron Company. They have considerably more debt than the other company, and so they would be considered a financing risk if they went to a bank and wanted to borrow money. Okay. Our last example is looking at bond pricing. So we have this Flagstaff company, and we're looking at the bond pricing, and we want to know, oh, actually, we're not going to do this example because we're skipping this part of the chapter. Okay, so this actually is something you will look at in business finance instead of accounting 1.